the briefing underway. Not really too much of movement going on at the open this morning. A couple of news items to just quickly run through, so it shouldn't take too long. But this morning then, stocks up a little bit here at the open. Since the cash equity open about half an hour ago, the DAX just creeping up. You've got yesterday's high coming in not too far from current prices, and we are trending up despite the slight gap lower this morning. Likewise, the S&P in the futures just coming up to also close proximity to that high that we had really towards the European cash close. Currency markets, the dollar's really quite flat overall, not really too much movement overnight in Asia. It's minor positive, maybe psychologically important, just sitting just underneath the 100 level. Likewise, euro dollar top left, probably worth keeping an eye just on that low print that was seen overnight in the Asia Pac session. That comes in at 0.759.5. Sub there, obviously you've got the S1 on the day, which kind of lines up quite nicely with that low print that was seen on the evening of the 1st, sitting just below there. Elsewhere, treasuries then, with some of this slight grind higher in equity markets, Treasury seen a little lower, down around 5.5 ticks. Just as a reminder for the newer guys, in terms of earnings season, you've had quite a few UK European names out this week, likes of Vodafone, AstraZeneca, BP, Shell, all those types of names. But actually, how earnings season typically works is that on a Monday and a Friday, they tend to be very quiet for corporate earnings. Same case as well for the US. They tend to be kind of centered around Wednesday, Thursdays, when you get the bulk of companies reporting. There's nothing really too much either to speak of on that front from this morning as well. A couple of things though to just quickly recap from yesterday, and obviously yesterday was Super Thursday. Bank of England was the focus, and a quick look at that. First of all, just marking up the actual price movement that we saw over the release with the rectangle here on the right hand side of my chart. And this is a perfect situation of strategizing ahead of a big event and working out what is it that the market is expecting and what is it priced for. And if you think about the Super Thursday event, it's actually a multifaceted release. You've got the rate decision, the asset purchase facility, the vote count, the minutes, and of course the quarterly inflation report. So there's a lot of things that are all coming out, which you would normally think that would be difficult then for the market to interpret what exactly it is going on. But this is when thorough preparation ahead of an event to work out what is it actually that the market cares about the most as it's focused, to then put a hierarchy of those different variables. And yesterday, absolutely no one was expecting an interest rate move. So the interest rate announcement is null and void. It's a non-event. No one's expecting an APF change. That's a non-event. So out of the variables, you've just subtracted two of them out of the equation. Then you look at the vote. Absolutely no one's expecting the MPC to make any kind of hint of movement at this point. So 9-0 unanimous, completely as expected, non-event. So your kind of 5, if you like, threats of potential volatility or complication to how complex the reaction might be, you've just eradicated 3 of those from the equation. Then you move to the quarterly inflation report and you look at something like GDP and the inflation forecasts. And when you look at the GDP ones, everyone, if you were astute enough to read the press, was anticipating UK growth to be revised upward, because Mark Carney was very pessimistic post-Brexit and in the last quarterly inflation report back in November. So growth forecast being lifted was very well telegraphed. All the analysts expected it. So that's 4 now you can forget about really focusing on. There was only really one key area that the market was concerned about, and that was inflation. And that's because inflation in the UK on various different levels, from manufacturing cost price pressures down to actual costs of goods that you're buying in the supermarket, that's the focus at the moment, because inflation's starting to pick up at a fairly quick pace. So really the question yesterday, amid all the noise, was what is it that they say about inflation and what is the inflation forecast. And actually, it all went pretty much as standard with the other points, as expected. No rate change, no APF change, 9-0, growth forecast up. The key here was really on the inflation side. There was no change on the inflation forecast. So despite this elevated move and this kind of fear that you're almost getting in the market at the moment, that the pound should start rallying as people start to price in actually pulling forward when the next rate hike might come from the Bank of England. And this inflation element, they said that actually we are happy to be tolerant of higher inflation for a longer period than would normally be usual. What the market was probably looking for was him to maybe slightly tweak the language to be a little bit more hawkish, to say that we're watching it carefully and we'll act if necessary to counter higher inflation. That didn't materialize, that aggressive a wording. Cable immediately sold off. There was a brief bout of volatility on the release. Then you had a more aggressive move to the downside. Then, like a momentum trade taking over with the breakthrough pivot, the natural intonation when you're seeing that type of price movement in a fast money move is to take it to the first logical target, which obviously you can see here was down to that S1 level. Then people kind of sit on their hands. No one wants to be holding a position going into the press conference. Now the press conference was interesting, and the reason why you had a bit of a hesitation in the move lower was that quite often when a central bank makes a policy announcement one way or the other, whether it's hawkish or dovish, let's say he's been dovish on this occasion on the inflation front, quite often then the press conference has an underlying hawkish tone in order for the market not to get too carried away with what the statement or the forecasts have said. So it's almost like balancing the ship, trying to calm investors that, okay, this is the policy direction, but we are willing to change that if necessary. So people were latched on to the press conference, and actually when that unfolded, he really didn't say anything interesting at all. He definitely didn't start to say anything more hawkish on the side of inflation. If anything, it was more just reiteration of what was defined in the conversation of the minutes and the projections. Then you had so two different types of trade, I guess. It was more of an aggressive momentum type trade on the back of the news. Then when the press conference started, when you started to see that really it was quite dovish in nature, that there was a classic there on the S1 and the perfect target down to that initial move on that kind of 25, 45 or just above there was actually that was the first. It went down to touch 25.52, which was yesterday morning's or the day before's low, and also that resistance level you can see highlighted on those three circles there. I know for sure Edward in the live room caught that trade. We were talking about it at the time. That was a perfect classic with a defined target to get a good decent trade on there. Then obviously questions that I start getting from some of the newer guys is, should I go short again now it's broke that level when it comes back up? Then I think you tend to be moving into the realm of believing of missed opportunity. There's been conviction in a move. It's been verified by the press conference. Now we have all the facts. Now I want to short it. But in reality, you've missed that trade then. If you weren't comfortable enough with the aggressive momentum one in the first part of the release at midday, there was the classic that was on at the beginning of the press conference. If you miss both of those, then it's just a case of you need to just move on and not dwell on that missed opportunity. Also as well, in terms of the remit of the size of the price movement overall, you're talking about nearly a 1.5 point move over that period. That's a pretty decent move, I think, with the information that was on offer with that latest announcement. So a couple things there from the Bank of England from a more, I guess, trade execution point of view. But the one thing for sure that I want the newer guys, the trainees, to be aware of is that this is how my mind works in order to gauge how the market should react or what it may react on, especially when you're talking about a multiple variable release. And certainly non-farm payrolls, we're going to get later on today, is certainly one of those, which is a similar type thing that you need to monitor. Just quickly looking back at my charts, just seeing the DAX then and the S&P both testing those respective highs from yesterday at the moment. So just keep an eye on that while I'm talking. The other thing as well, and I heard Vas talking to his guys this morning, and he made a very good point in regards to this week has been a lot more busier in terms of scheduled economic data. Obviously, Trump's been pretty active throughout the week, which has caused some volatility. There's been some pretty good trade opportunities. But actually, I'm just going to share with you this stat. This is the S&P 500. So there's been 33 consecutive days that the S&P has not had a 1% daily range. It's the longest since 34 in a row. You'd have to go back to 1995. In fact, if we go back to the last 6 trading days, because the S&P closed down last night, the last 3 closes in the S&P have been minus 0.09%, plus 0.03%, and plus 0.06%. So you're talking increments that are basically unchanged. And in fact, if we go back to the last 6 trading days, the index has closed either up or down by less than 0.1% of 5 of the last 6 trading days. And I think what can often happen with lesser experienced traders is you get used to volatility, and then what starts to happen, you get a day when there isn't that type of movement. Let's X out the Bank of England pound situation, and then you start trying to trade with the same method exactly that you had done on previous days, and you're not assessing truly, objectively, that specific day on its own. Because the same principles might not apply, the same correlations, the news is different, the way the market is positioned is different, the volume liquidity is different, and these are all things that you need to take into account each day. So each day there will be these subtle changes, and I know a few people struggle with that or picking up on those signals, so it's just something to be aware of. Okay, I do know there's a couple of questions in the chat. I will address them once I've gone through the rest of the news in the briefing this morning. A couple of other things just to be aware of. These are kind of lesser, I would say, market moving for the assets probably that you guys are looking at. But let me just bring over the Japanese yen from overnight. There's definitely been some quite erratic price movement in Japanese bond yields and the Japanese yen. So this is dollar yen. You can see here really during the beginning of the Asian session, so 1 o'clock we saw quite a sharp move downward, and then we got to 3:30, a big snap higher here in the Japanese yen. So quite unusual to see this type of quite definitive price movement in opposite directions. So a couple of things here to be aware of. The whippy conditions order of play in Japan in bond and currency markets. So basically the Bank of Japan conducted its first unlimited purchase of government bonds at a 10-year maturity. So the news prompting a sharp drop in bond yields, which move inversely to price, as well as yen undoing moves earlier in the day when the central bank offered to buy more bonds than initially expected. So this whole kind of targeting of yield in terms of the pledge from the Japanese central bank, these are operations which are really quite a new process, and I think the market's still getting really used to it, and so there's a little bit of misinterpretation maybe of how to manage trading these. In contrast to the first rate auction, the Bank of Japan said earlier this morning that it would buy 450 billion yen, so it's about $4 billion, of 5 to 10 year bonds in the market, mirroring the size of previous round of purchases a week ago. However, the BOJ said that its monetary policy decision, it planned to wind down back the size of today's purchase to 410. So a couple of movements as well around the parameters of those auctions, if you like, for that Japanese government bond deal. Elsewhere, it's almost the boy who cried wolf now when I listen to Kuroda. The Bank of Japan will pursue powerful easing to hit its price goal. This is kind of copy, paste, repeat when it comes to Japan, I guess. Quite forceful wording, I guess, if you weren't familiar with the kind of communique from the Bank of Japan. But this is very much a reiteration of what basically is always said from this chap, Mr. Kuroda. So nothing really particularly new there, so to speak. Moving elsewhere, can't go a briefing without mentioning the Donald. So this is probably the one that you're hearing about quite a lot this morning. Report in the Wall Street Journal last night. President Trump will sign today an executive order to water down the 2010 DoddFrank financial regulatory framework put into effect, obviously, during or as a result of the global financial crisis. This is kind of the key area of which why the bank stocks were so moving so aggressively to the upside upon the period of winning the election early November all the way up to the inauguration. Banks like Goldman Sachs rallying in excess of 35% is because they would be the net benefactors of a watering down of these regulations. Now, this kind of move definitely splits opinion right down the middle. Those that say that these rules have been specifically put in place and have worked in order to safeguard the economic system and the kind of person and man on the street. However, there are those that are saying that there's now too much red tape for these banks to operate, and therefore it's to the detriment of the overall global functioning of the system if the banks can't operate freely enough. So definitely a positive for the banks, and maybe I'd say a lot of this has been priced in already. As I say, the likes of GS up already double-digit percentages, so a lot of that has already been factored in. But maybe something you'll hear Trump tweeting about later on when he rolls out of bed at around 11:30 our time and starts tweeting. The other thing about the Trump administration, another headline that I saw, the US President's Defense Secretary last night warning North Korea of an effective and overwhelming response if Pyongyang chose to use nuclear weapons. I guess you're taking it to a slight extreme when Trump says, "I'll fight fire with fire." Fighting nuclear bombs with nuclear bombs, are pretty clear how I think that will end. But hopefully I'll be in a much happier place than sitting here squawking on a microphone when that day comes. Okay, let's get down to the non-farm payrolls release. We'll have a quick look at this because I know we'll go through this in much greater detail as we get closer to the event. One word of warning before we do look at non-farms is that typically the morning of the payrolls report is very quiet. If you think about it from a larger institutional flow point of view, any kind of block order trades being executed, this is not the time for that type of activity to happen because of the net volatility that's about to hit the market in a couple of hours' time. So therefore, usually these types of mornings are very quiet. So please have realistic expectations of what you are going to get out of respective market movement this morning. Things like the low in euro dollar, which is getting close to testing the Asia Pac, these yesterday highs in the DAX and S&P that they're trading up and around at the moment, might have more gravity to hold given the fact that not many people want to be pushing the market at any sustainable long-term positions or with any too big size. If any trades, you want to have realistic time frames and exposure into those trades, I'd say. Before we just get into payrolls though, the one thing to be aware of this morning, you do have UK service PMI number coming out. So this is what that previously looked like. The service PMI, obviously a critical component of the contribution of economic growth in the UK, given our heavy dependence on the service sector. The last reading exceeded expectations. In fact, as you can see here, we've been on a steady upward trend with the last reading being the highest value since July of 2015. So looking at the expectations today, we're looking at a 55.8 reading. So pretty much keeping pace with this decent performance thus far. But any cable traders, I would be monitoring this out of positions ahead of the release and then acting accordingly depending on how it comes out. But a fairly solid number, I think, overall, i.e. being up at best levels in 2 years is what's to be expected. Really, to shake things up, given the pattern's been to the upside, given UK economic data's been still fairly robust on this particular reading, really you're looking at anything like a pullback to sub 52 maybe, which puts us back down at the post-Brexit type lows, then that would be interesting. Upside surprises even at 58. Again, you know, this is coming in the context of raising price pressures. Upside numbers could further fuel that kind of recovery from some of the loss that was taken yesterday in cable. You've got, well, let me just quickly look at the chart here in cable. Change my screens. So now you've got that previous, what was quite good support originally yesterday, that 25.52 level we were just looking at. On the upside now, we're trading around 10 pips shy of that, the futures. So I'd say that's kind of the first target upside resistance. If the number's strong enough, any break of that could be a classic then on a pullback up toward pivot. Good number, I guess you're looking at something, if it's expected at 55.8, any number at 58 plus would be enough to kind of stoke that price action in that kind of size price movement of 50 pips, I think would be reasonable. Certainly as well, given the fact that the market sold off a sizable amount yesterday, positioning wise. Okay, looking at payrolls then. Like with anything, with payrolls, it's about the summation, if you like, of the jobs data we've had throughout the week in order to give you a bit more of an insight as to how the Bureau of Labour Statistics report may come out. Now, non-farm payrolls today is expected at 180,000, 180. The most pessimistic estimate on the street for the headline reading is 140,000. The upside is 238,000. So that's your realm, if you like, of what the market is positioned for. 180, 140 on the low, 238 on the high. Obviously, we had ADP, which is often seen as the most clear kind of barometer of health, the private employment reading, and that blew forecasts out the water. 246,000 puts us up at the highest level since really June of 2016. I think it was 246, expected was 151,000, so it was almost 100,000 higher than expected for ADP. We start looking at the other numbers. You've had the ISM manufacturing PMI, that's been consistently rising on the headline figure. It was the highest reading since November 2014. New orders, production and employment increased. You then look at the non-manufacturing PMI. That was fairly consistent reading on the headline, matching the highest since October of 2015. New orders increased, but business activity and employment eased. So in non-manufacturing in the States, the employment constituent actually eased, but it was up on the manufacturing side, and ADP was extremely strong. So when you're looking at non-farm payrolls, obviously today's consensus is 180. The previous was 156. You can see here it's been kind of 180, I guess, puts it at the mean, if you like, of what we've been seeing more regularly over the last couple of months. But you would say when determining then what the whisper number is, given the outright lying strength of ADP, the whisper number is probably leaning to a slightly upside number. I would say probably more akin that the market's then reaction when you're determining it from, if we were looking at the headline alone, the market's probably more positioned for 180 or above rather than 180. So the whisper's probably more like 190, that kind of level. So that's definitely what you guys should be doing ahead of these releases, is looking back to what information do we have and how has that performed. Now, a very interesting thing that happened actually earlier this week is that when ADP actually came out, this is the non-farms I'm showing you at the moment, but when ADP came out on Wednesday this week, obviously it was a super strong number. The market had a short-term rally, then actually US equities sold off. Now that's a very interesting play there. Now the dollar strengthened, gold fell, but US equities fell. Now this is breaking slightly from the pattern we've been seeing in recent months. Normally, good data means strong economy, gives confidence to investors in the equity market. But actually, what you saw with the ADP number, it was so strong, is that actually, what does this mean for the Federal Reserve? What if you get a non-farm payrolls reading at 300? Now, at what point do the Fed get forced down the route of that those guys need to start reevaluating their gradual, cautious rate trajectory? They need to start tweaking that wording, losing some of that cautiousness, and actually the market needs to start bringing forward a viable near-term hike. And what if 3 goes to 4 on the rate trajectory? And if that happens, you would probably think that would be a net negative for equities, and that equities have been benefiting from a very slow renormalization of policy from the Fed, i.e. continued long-term accommodative period of economic stimulus, so to speak. If the Fed have to react and change tact, markets need to reevaluate. And coming under the uncertainty of the Trump administration, where he's spoken it's been net negative for equities as well, if you get stuck into a situation where you're having to raise rates amid political uncertainty, that's going to be probably a net negative for equities. So it'd be interesting to see how they react today. With the way that was reacting earlier in the week, I would say that you want to be extra cautious or vigilant with how equities specifically might react. The cleaner, more linear moves have actually been happening in the dollar if you had a strong or weak report today. And that's probably what assets I'd be focusing on more at the first instance. Okay guys, I'm going to leave it at that though. There are other data post payrolls that you do have. Obviously within payrolls, numerous breakdown of other figures, in particular the average hourly earnings we'll be watching, but later in the afternoon factory orders. The ISM manufacturing actually is coming out this afternoon according to the calendar, but that's really then a non-event because it's come after the main event, so to speak. Looking elsewhere, you've got Constancio at 12:45 and Feds Evans at 2:15, so a couple of speakers to be aware of, but again please keep in mind realism over the fact that the markets typically are quite quiet in the morning of non-farms. Then there's the flurry of activity that could then provide thereafter the trade opportunity, and then things tend to fizzle out quite quickly going into the afternoon period. Okay guys, have a good session and a good weekend if I don't speak to you before then. Thank you.